First up on the agenda, mining giants BHP Billiton and Glencore Xstrata reported results this week that despite production records being set in a few commodities reflected lower commodity prices. Billiton's lack of interest in Africa and more specifically South Africa has been in direct contrast to Glencore's foray into the continent. Here to give us his thoughts on the resources space, we're also getting his checklist, a safety checklist for investing in small cap resources. Quibus Null from Stand-Up, thanks for joining us, Quibus. Let's start off with the biggest and strongest right now when we're talking about the overall mining assets. Annual profit of BHP Billiton was down 30%. That, as we were saying, reflecting lower prices. But what really is interesting right now is the lack of any comment really about South Africa, given it used to be the underpin to Billiton's earnings when they merged. And I suppose the fact that they really don't have a strong African presence at all.
Yeah, at the moment the portfolio seems to be dominated, or is actually dominated, by iron ore, which presents roughly 50% of the operating profit, and then the petroleum business, in the US, which is another 30%. So those two combined, Australia and the US, sort of presents around roughly 80% of their earnings. Certainly concentrated in those areas, and they've been a company that always believed in tier one assets that's scalable, expandable. And they seem to be staying true to that thesis, as we've also seen from them now committing $2.6 billion to the Jansen project, potash project. And certainly there was maybe some other acquisition opportunities for them, like Mosaic or some of these, which they could have done for maybe a similar amount with potentially less risk. But I guess their strategy to sort of stick to these bigger, scalable tier one assets is still holding true.
What struck me, Quibus, obviously in those results is the degree to which they've obviously controlled cost and cut things like the pipeline investment, which goes into the exploration assets going forward and developing greenfields projects as opposed to the brownfields projects they're focused on at the moment. I mean, we also saw Xstrata CEO actually commending the industry and saying well done, because we're actually starting to see a bit of supply side discipline now. So I mean, long term, does this, regardless of what happens on the demand side, it looks like it bodes fairly well to support commodity prices, because when you see these big mining companies reining in their future pipeline expenditure, I mean, there's not going to be a lot of supply coming on, or not as much as we thought initially. So are you pretty positive on that side of things for commodity prices going forward?
Yeah, certainly. First of all, I think Billiton has always been a great example in the sector of controlling costs, the ability to control costs, and stay disciplined. I think that has sort of been a standout. Secondly, I think, with a lot of the capex coming out, I guess a lot of these companies did got a little bit ahead of themselves, in the good old days before the global financial crisis in 2008, 2009. And certainly, I think, they all thought, I guess, the growth we've seen, and even coming out of the global financial crisis from China, we saw immediately, almost a couple of months out of the global financial crisis, record imports in iron ore from China. And I think a lot of that stuff was extrapolated as being the norm now for the next 10 years or so, and everyone opened their taps and they invested, or they committed, and they sort of said they're going to massively expand their operations. And I guess coming into this sort of last year and certainly into this year, the realization of maybe demand isn't where we thought it is, and we will have to, on a material basis, or substantial basis, basically, cut back our capex that's come through. And I think that in its essence will sort of set up potentially a new cycle where one could look forward to better returns again.
Before we get to that checklist, because we're also going to talk about the small cap space, let's just get a comment on Glencore Xstrata in Africa right now, because while Africa is kind of really a non-event for BHP Billiton, it's a very important part of Glencore Xstrata's business going forward. So shed some light on their assets in Africa right now, and whether riskier means perhaps better returns when we're talking about mining.
I think it's important firstly to understand that Glencore Xstrata is still to a big extent dependent or exposed to more the trading side of commodities. So certainly that helps a lot. And we've seen how resilient they've been in the last set of results, especially on the thermal coal side, where price has been extremely weak, but they've managed through their trading business to actually maintain profitability and sort of keep things going. So certainly I think that is a quality of theirs. And maybe when you operate in Africa as well, you've got to be a slick operator. You know, I think in many times you've got to have the relationships. You got to have the ability to get your product to market, to the right markets, etc., etc. And you know, that type of you know, theme sort of fits in nicely, I guess, to the overall business model. And maybe that's the contrast to BHP Billiton. It's sort of shaded away from South Africa and Africa in general, and sort of chose more the more established markets like Australia and the US, whereas some of these other operators have chosen to take on Africa, you know. And I guess time will tell, you know, in the end of the day, whether you know, sort of the more risk-averse option versus the operators that's taking on and going to risk is you know, which one of these will actually be paying off sort of a better yield in the end of the day.
Kobus, we've got very little time, so you're going to have to give us a very brief response, but we're very keen to understand what your emergency checklist is for investing in small cap resource stocks, especially the monoline or single commodities stocks. We've probably got a few seconds just to get your thoughts on that, because they look so cheap at the moment.
Sure. Three quick things. It's got to have a good asset. You know, it's got to have the ability to generate cash through cycles. Secondly, you know, it's got to have a reasonable, strong funding structure. You know, ability for the company to absorb volatility when it goes through the cycle. And thirdly, it's sort of got to have infrastructure. You know, it's got to have, or the ability to create that, or to put that into place at a reasonable cost. And I guess if you've got those three, you know, it's sort of a reasonable platform that you can operate successfully from.
And the one stock that ticks all those boxes with a big tick is?
Small.
Yes.
Look, you know, at the moment the company maybe locally, like Atlatsa, you know, from Bokoni, which still sits under the Anglo-American umbrella as a PGM producer, a small one. That's, you know, from operational perspective improved quite a bit. You know, and I think it's got the protection from Anglo-American as well.
Yeah.
And certainly I think that is a company which, if you're looking for one of the smaller names, I would throw my money behind.
Money and honey.
Yes.
Honey, money. Thanks for joining us today. Kobus Snell, Resources Analyst at Stanhope. After the break, we're chatting to Liang Du, Portfolio Manager at Prescient Asset Management. Do stay tuned.